Today's rapid fire question is, what happens if the appraisal comes in lower than the purchase price? Hey everybody, my name is Chris. I'm a broker owner located out of the DC metro area, licensed in 15 states. This question is coming up quite often these days because of the fact that there's bidding wars happening during the purchasing process, and the prices are actually continuing to increase because there is a shortage in the inventory. And I see it common across my clients as well as in the Facebook group. So I wanted to share this video to kind of guide you through what actually happens if the appraisal value comes in lower than the purchase price. So let's take a look here on the screen. So we'll see here right now, I have four options: option 1, 2, 3, and 4. The option 1 and 2 are going to be based on a 3% down payment, and option 3 and 4 is going to be initially based on a 15% down payment, but I'm going to walk you through it. So let's first take a look at option 1 and 2. So on option 1, the initial offering when they were going through the negotiation was a $400,000 purchase price. So we're estimating that the value of the property is going to be $400,000, a 3% down payment, which is about $12,000. So the loan amount is going to be $388,000 or 97% LTV. I'm keeping the rate constant across all of these scenarios, but just note that, for a 3% down as of today, it's going to be roughly around 3.69 to 3.75%. For a 30-year fix, but I'm just keeping it constant just for an example's sake. And then the mortgage insurance based on these loan amount is going to be accurate, so $100.23. And then for the cash to close is going to be a combination of the closing costs, which is anywhere between 2 to 3%. I'm going to take about 2.5, just right in the middle, plus the down payment as the cash to close. So we're going to see here a net cash to close of about $22,500 for a $400,000 home at 3% down with no lender credit. They're not buying down points nor receiving lender credit. We're not accounting for any seller credit that they might have negotiated in for. Okay, so I'm just taking here $22,500. Now, if the appraisal comes in $10,000 less, what would happen? So let's take a look here. So it came in $10,000 less. Now the loan amount is always going to be based on the appraised value of the property, not the purchase price. Because if you think about it from a lender's perspective or a bank perspective, they want to lend you based on the collateral that they're lending against. So here it's going to be 97% of $390,000 appraised value, so $378,300. Now the payment is going to go down as well as mortgage insurance because it's related to the loan amount. But you'll see here the estimated cash at close increased because of the fact that the client now has to come up with a gap between the purchase price and the appraised value by $10,000 plus the 2.5% based on the purchase price. Okay, so it's about 32 and change. So it's kind of like how it works if you were bringing the most minimum down payment possible, which is about 3% for a first-time homebuyer conventional loan. Now, here we want to look at two different options. And this was a live scenario where our client, they were going to put 15% down, so $60,000 for a $400,000 home. So that leaves about $340,000 in the loan amount or 85% LTV. Now you can see because the loan amount is so low, the PMI is actually pretty low. It's at $28.33. Now, if we take a look at the net estimated cash to close, which is 2.5% of the purchase price, which is going to be the closing cost plus the $60,000 in down payment, they're a little bit under the $70,500 in total cash to close. Now, if the property again came appraised at $10,000 lower, what would happen? Well, in this case, the client wanted to keep their payment exactly the same, the PNI, at around $1,500. So their loan amount is going to stay static. It's going to stay the same. Now the PMI is going to increase a little bit, right? About what, $14 is that, if my math is correct. So $14 is going to increase, but they really didn't care. $14 extra, keeping the loan amount the same, and their closing cost is going to stay the same. The reason why is because all that changed was the PMI. Their loan amount stayed the same because it moved above the threshold of 85% loan to value ratio because the appraised value dropped, right? Because $340,000 divided by 390 is more than 85%. But the closing cost is going to be, 2.5 of the purchase price plus the difference plus the down payment of $50,000. If you're not bringing in just the ultimate minimum down payment, it shouldn't really impact you. You know, the PMI is going to change, but nothing else. Now, if you're going to be bringing 3% down, or let's say 5% down, and there's a significant difference in your appraisal value where the appraisal value is lower than the purchase price, then you're going to have to be ready to bring additional cash out of pocket to close that loan. I hope that was helpful for you. If it was, please comment below. Please like and subscribe, and I'll talk to you later. Thank you. Appreciate you.